As Warren said, everyone knows Brian. It's a real honor to be up here with him. I got the honor, I guess, because I'm now the senior director, the longest tenured director on the bank now that Chad retired. He and I joined the Bank of America board in 2004. So together, the two of us and Brian rode an incredible roller coaster, one of the deepest recessions in the world, and then an incredible recovery that continues to this day. That board appointed Brian CEO back in December of 2009. Not a particularly good time in the history of banking, but in hindsight, it was a great decision that the board made, that's for sure. Brian refocused the bank on a very simple, straightforward strategy, customer-focused, not just selling financial products to anybody that wanted them. He wanted to serve the three groups of customers that we do so well today, individuals and helping them through their lifetime financial needs, small and large companies to help them be successful and profitable, and of course, institutional investors, which is our third group of customers. He came in and cleaned up what I call a financial crisis balance sheet, divesting dozens of non-core businesses, grew revenues over those 9 years to what today represents record levels of profits and revenues, all under the banner of responsible growth, which I'm sure he's going to talk about hopefully a little bit more today. Today, Bank of America is one of the 10 most profitable companies in the world. But what I believe is most impressive is that, as you know, in these times, Brian had to also preside over taking $20 billion of costs out of this business. And yet, today, Bank of America has the highest levels of employee satisfaction and employee engagement that it's ever seen. Hopefully, we'll get into that a little bit too, because I'm sure everybody likes to talk about corporate culture, and Brian does pretty well in that. Lastly, I know Brian won't brag about the bank and its accomplishments, so I'm going to for him because we've been on quite a roll lately. Euro Money magazine in July ranked Bank of America as the world's best bank for 2018. That's a picture of Brian and, oh, who's this gorgeous? Oh, that's Anne Finucane on the other side.
You know she has.
She gets more of an applause than you.
The rest of us look like we're kind of ragtag, but Anne's perfectly coiffed.
Yes, as always, as always. Warren mentioned how impressive Fortune magazine was. In August, Fortune ranked Bank of America as the #1 bank and the #3 company in the world overall, and it's changed the world rankings, which we'll probably also talk a little bit about that strategy. And last but not least, and then I'll get on to the most important thing, is talking with Brian. Barron's last week had an article, Bank of America, slow and steady wins the race. And just to quote, it says, Bank of America has one of the better earnings outlooks among its peers, a leading consumer banking franchise, a lucrative and industry-leading wealth management platform anchored by Merrill Lynch, modest international exposure, strong expense controls, which I referenced, an aggressive stock buyback program, and it also has a top-notch CEO in Brian Moynihan, who has repeatedly stressed responsible growth and achieved it. So I'm pleased to be a director of that bank, and now let's get over to that top-notch CEO and find out what's on his mind. I referenced, Brian, I couldn't resist mentioning the Barron's article and, of course, all the accolades that you've been getting for your responsible growth vision. But it wasn't necessarily an easy vision to sell to the world originally when he began this. I know that no one has worked harder on convincing your teammates, and that's what he honestly refers to and treats his employees as, teammates. But he has worked hard to convince them of the importance of that to the success of the bank. And so if you would, just kind of define that for the group, what you call responsible growth, and how does it drive you every day in your job?
Well, we think about, first you have to think of why we started really focusing on responsible growth. For the first, I was here in this seat at this thing, this event in August of 2010, and most people weren't sure whether I'd be here or the company would be here shortly thereafter. But you should have bought a lot of stock. So if you think about it, we had for the first part of the decade, we had to work through having a 20% market share in mortgages and working through all the ramifications to individuals who had to be modified and things like that. We built up 58,000 people working on that. We probably have 9,000 or 10,000 people working that division today, from about 10,000 to 58 and down. That was a lot of work. We had a lot of lawsuits. We had a lot of people who changed their opinion of what the deal was, so to speak. And we took we ended up in 11 taking a $21 billion charge in a quarter and still made money that year, still lost a little money due to a goodwill write-down. But underneath this powerful engine was going on, and we were spending a lot of money making the franchise better. We were growing the customer base. And as we got to the first part of 15, we'd settled the last lawsuit, I had to get the company, and we had to get the company management team, Ann and I and our colleagues, to focus on growing. Yet we didn't want them to think, let's go back and see what we can do here. Because when you have an engine the size of our company, you can lean it the wrong way, it will go. And so if you want to see how many credit cards we can produce without great credit quality, you can do a lot of them. We did 5, 6, 8, 10 million a year for a while. And so we started to say, how do you sort of have the paradox of the and deal with it, and that's responsible and grow. And so I basically said, we got to grow, no excuses. That's the first tenet, because if you don't grow, this management team will be gone, and the investors will want somebody who can grow, because that means you're winning the marketplace. It means your products and services are capable. You got to do it on a customer-focused basis. That defines who you do business with, how you do business, the way you think about how you examine the company and the clients, and then how you work and develop solutions for those clients, as opposed to saying, how can you make money? It also means no acquisitions, which are not legal for our company, which a lot of people didn't understand, haven't been for a long time since we went above 10% deposits. So it means you're all organic. So got to grow, no excuses. Got to do it on a customer-focused basis. Got to do it in the right risk framework. And then the last part is critically important in the world we're in today, which is you got to be sustainable. You have to be the best place for teammates to work. You have to share your success with your communities, and you have to drive what we call operational excellence, which gives us the permission to save money, to invest in the future of the franchise, $3 billion a year in technology, 3,000 new salespeople year over year, things that you just can't fathom. But to do that, nobody's saying you can grow your expenses faster than your revenues. So that operational excellence gives us there. And so I literally thought about this the day I was going to talk to 225,000, 30,000 teammates all at once after our earnings call. And the principles were operating principles we've been playing with, and I basically just went off script and said, we're going to drive responsible growth in front of 230,000 people, never having practiced the concept. And teleprompter flippers going like this, trying to keep up with. And what happens is it resonated, because we were ready to take the field and just destroy the competition, but we wanted to do it the right way. And at the end of the day, it's now embedded deep in the company, and we have from the board on down, everybody agrees this is the right strategy. So we won't grow as fast as some people on a given day. We're taking more risk, but that's fine. But we'll be here to keep growing even when they're not.
Let's shift over to the economy and crazy markets we're in. It's been a long recovery. Everybody's questioning whether we're 3/4 of the way there, halfway there, all the way at the end. No one has a better purview on this than you. You have a data-driven business, and you are the data master. He is a data-driven CEO. So what's your view? Where do you think we're heading from this point?
So we have two things. One is we have a lot of insight. So 1 in 2 consumers does business in our company, so you can see what's going on. Literally every week I get a report of how the spending's going compared to the month to date, year to date, whatever you want to look across all these categories. And the second thing we have is a research team is #1 in the world, I think 6 out of the last 7 years. So Robert, you got a pretty good franchise, but that's a pretty good franchise too. And they're very good. And so what they predict, just to give you this numbers is we think the world will grow at 3.9 for this year, 3.7 next year. U.S. 2.9 to 3 this year, 2.7 next year. Europe 1.9, 1.5. China 6.6, 6.1, and India 7.9 and 7.5. And so why do I name those two economies and stop? Because the rest of them are relatively small on a relative basis. And so there's a couple things to think about. So the U.S. consumer economy is $12 trillion round numbers, which is the same size as China. So if you understand where the U.S. consumer is spending, you're going to understand where the U.S. economy is going. The U.S. consumer at Bank of America will spend $3 trillion during the course of a year in bill payments and checks and debit and credit cards. $3 trillion, which against a $20 trillion economy is not a bad sample size. Through the end of October, those consumers spent 9.5% more than they did last year through the end of October. The year before that would have been 6%, the year before that would have been 3%. So consumer spending continues to accelerate. I've been tracking for 15 years, so I see it. You see the nuances, ins and outs, and I remember I took the board through one day just all the categories, and there's lots of things you can talk about, but that is just a phenomenal rate of growth in consumer spending, and they're not over leveraged, so there's not, Peter Lynch and I were talking earlier about housing isn't over leveraged, so you don't have that problem we had before. That if things slow down, they're going to have to pull back because it's more fundamental earnings and wage growth. So that's a good measure. And to give you a sense, the Chinese economy we think is growing 6, whether it grows at 6, 6.5, that's good for the world. Europe's growing. So it all looks pretty good. And then if you go on the commercial side of our customer base, what they're telling us is they're making more money, they're selling, the leverage in certain segments and stuff is people are doing leveraged deals in the private equity space, but the general corporate company has deleveraged quite a bit because just earnings. They're just earning a lot of money. And so that's the good news. The question is what is on their minds, and that's going to be what stops the consumer from spending, and that's going to be what stops an employer from paying them bonuses or hiring more of them and things like that. And that's going to come down to a little bit just confidence in the business side of the U.S. and the business side of the world, which is still strong, but with all the noise about trade wars and Brexit's going to screw up the UK, EU economy and things. You get a lot. You can get your parade of horribles in pretty good line. But right now, the actual impact of those is not a financial impact or a numerical impact. It's actually an emotional impact. But that's what we got to watch for the next few months.
Brian, you referenced China, and you referenced a growth figure, but it's not as robust as some people would have liked it to be. There's a lot of concern now about these trade tariffs and trade wars, and people are concerned that if the Chinese economy does slow down, that's going to roll back and hit the world. What's your thoughts on this trade war and China in general?
I think that you have to separate the principles of what the administration is trying to achieve, which is reciprocity in trade across the world, which is basically the thought that we ought to have an equivalent set of rules that people can operate in China if China can operate in the United States, and likewise with the other bilateral agreements. The problem is we're not there, and so the question is how do you get somebody there, and that's the technique, which basically raising tariffs gets the attention. A lot of written, and I don't have a particularly strong element to add, of the merits of that because everybody has their opinion. But the underlying principles, the last administration and this administration and the administration before that have all agreed to: IP protection, the ability to operate freely, the ability to not be subject to the bureaucracies that slow you down, and all that stuff is critical. Data, to run our operations in China, we have to leave the data, and the computer system has to be separate and things like that. And so those aren't fair, because a Chinese bank can operate in the United States largely without restrictions. So, I think that's what they're after. The problem is the device to get there. It creates a lot of worry on the part of people, because if you're in certain industries, your supply chains already had to start passing through some cost. And the question is, in this relatively common inflation environment, it's hard to pass through price. And so if you're in apparel and things that were dependent on that chain, it's difficult. The rest of the actual numbers, if they tax it all up, is maybe 0.5% of growth in the U.S. economy. That's a big number, but on the other hand, it wouldn't change things. It changed the world, but it's the worry about it, and so I think we got to watch it, and hopefully they'll settle into some agreements. You saw Mexico and Canada and the European thing were very important to show that we could actually agree with somebody on something. But China is a lot more difficult. It is a very difficult situation from a negotiation because there's just a lot more at stake.
They take the long-term view, as they say. You mentioned Brexit off the top of your head. I know how much thought you have put into it. And in fact, Bank of America decided to have its EU headquarters in Dublin, which you are establishing as we speak. Give me a sense of what you expect for the bank in Europe.
Well, if you look at our European operations outside the United States, we work with large companies, multinational companies, both inside and outside the United States, wherever they sit, and we work with the largest investors in the world, and a lot of people in this room are our clients on the investment side. So, we're not in retail businesses and wealth management business, so we're not susceptible to the general economic moves. But we are concerned. So what are we doing? We're spending a lot of money that no customer's getting one thing better than they had before. So we are basically dividing a system that was aggregated into one into two, and there's no feature functionality or client capabilities or new risk we'll take. And it's I don't know, what are we, and $300 or $400 million in this thing? And we don't even know exactly what the rules are going to be. And so he multiplied times all the people, and we're moving people around, we're disrupting real people's lives. This is not good for Europe in the near term in terms of just disruption. And then the negotiations are very difficult. So those of you know the Ireland situation, the border situation is almost impossible to figure out, and you see the ebb and flow on that. And then you have things that are very easy to agree to, which is like packaging on goods and services. Nobody's going to change a candy bar wrapper device. There's no reason to, so that'll go through easy. But the border, and then ultimately how you want financial services to operate. And I think the mistake that can be made here is Europe had never really aggregated financial services, and therefore they didn't have a deep capital markets. Therefore, when the crisis hit, they could never move the assets off the balance sheets of the financial institutions into markets and reposition them. And they're still struggling with that today. And this now takes one of the larger economies and divides away from the others, the two sets of rules. You can't have common prospectuses for mutual funds. All that stuff goes away, so you end up with two sets of rules. So you're disaggregating liquidity and stuff, and it's not going to be good for the continent. And so it puts them back, probably 10 to 50 years in the possible development of capital markets, which is critical to the country's success. At the end of the day, what makes U.S. powerful is our capital markets and all the capital we can bring to the situation. And that just allows us to develop wealth faster for people, and companies can get access to capital a lot faster. And Europe doesn't have that, and this is going to put it back a few years.
I'll switch the topics a little more. At our board meetings, we spend a lot of time talking about the potential technology disruption. In fact, one of Brian's favorite subjects, and he immerses us in what's happening in the world, and so it's been a fascinating place to look at it. In the last 5 years, I think you've invested over $20 billion in technology and systems. I think as a result, we have the slickest consumer and business banking platforms, and I could have brought a bunch of magazines to confirm that also, but it's been an incredible shift the way customers now interact with us than the way they did 5 and 10 years ago, or even yesterday. Could you talk a little bit about the implications of managing a large company like you do in a modern workforce in an era of big data, AI, machine learning, robotics, et cetera, et cetera, et cetera?
So a couple things. One is, we're also, as we said, we want to be responsible and grow, which some people think is inconsistent. You also have to be large and innovate, which some people think is exist. It's absolutely not. So we just saw one of our colleagues give a presentation, and I think we have 3,500 patents issued, and we get more than anybody else. And so, we're like the top 50 patent holders in the world right now, and so we drive innovation through the company. It's big, so it has to be done in a way that can be scaled immediately, because you can't throw little things out there. But I think the broader implications of the technology that will be applied to services businesses over the next decade are just huge for companies, all our companies and all our institutions to think about. Because if you take voice recognition, so this Erica thing, which 4 million people are talking to today, and you can tap or text or type text or talk to it. That didn't exist a few months ago. Now 4 million people are using it to interface, and it's because the natural language in it is possible. And what do I mean by that? If you go into Google, say Google, and talk to it and say, what's my balance? You might get an invitation to a yoga place, right? In a bank, you have to have something different. So the first thing we had to do is go out and get a natural language built for financial services that was different so that because we couldn't rely on the available sources. Then you sit there and say, what else makes that possible? Well, you have this mobile device, which is a smartphone, which didn't exist until 2007. We were the first app that was available outside of Apple apps on it. That's why we took off. We have 26 million mobile customers today, and growing. 1.6 billion mobile and digital logins last quarter or something like that, 1.4 billion or something. And so you think about that phone is now possible, which is basically a computer in everybody's pocket, or a branch in everybody's pocket, we call it. And then the networks that actually work. And then the ability to have data stored and removed in things. We have 110 systems sit behind your mobile phone. And when you talk to it, you think about it, anyone of 25 million, 26 million customers could pick it up and ask one discrete question, and 110 systems have to snap to attention, and instantaneously it has to go back to the customer. That takes all parts of that equation, the artificial intelligence search for the answer, and the thing. Now, I'll make it really simple. You send a payment, you want to know your routing number. If you got to pay your kid's college tuition, you go on the thing, they say, what's your routing number? And everybody goes, I don't know what my routing number is. Well, if you look at the bottom of your check, your routing number is not proprietary, it's not secret. It's all the same for all of you that are our customers, and those of you aren't should be, so go get checked. But anybody under the age of 30 doesn't know what a check is, so they first of all don't know. So we get millions of calls a year where people say, what is my routing number? So if you're using Erica and you've ever asked it that, the first thing it does when you open up, it says, you need to know your routing number. And it doesn't even make you go into anything else, and so that saves us millions of calls. And so there's a tremendous efficiency, and the customer's happy because the last thing the customer wants to do is dial 1-800 or call somebody or look around, and they can just do it. So that kind of technology overlay will mean the world's going to be a different place, and then far different than we can fathom today, but we have to be that innovative as a company and drive it.
It is fascinating. The change is coming so quickly. And speaking of change, I think one of the most difficult jobs that you've done, but one that you've done so well, is reducing the bank's workforce from about 285,000 of your teammates to now about 2,005,000 teammates, while maintaining and increasing employee satisfaction and engagement. Everybody talks about a company's culture. You don't really know what it is or how to measure it, but we all know it's important for success. How do you approach this issue every day?
Well, I think there's a sign of not being a good management group is to have massive layoffs. Because I think you can, especially in a more predictable business like ours. And so the worst time in my business career in a crisis was not, walking to the floor, the trading floor, and finding out one of our major clients couldn't fund and things like that when you knew all hell was breaking loose. The worst time was when we said we have to lay off 10,000 people in a week. And I said, we can't do this. So we have been hard at work to figure out ways to mitigate all that technological impact, which is what enabled us to go from 280,000 people to 205,000 people, by planning way ahead, by looking 3 or 4 years ahead, and then by doing it the right way with tremendously, year and a half severance for everybody who worked at the company 20 years and stuff like that, to mitigate it. But the real way to mitigate it is let attrition be your friend and not hire people that you're subsequently not going to need. And so we've got a very disciplined human resource practice to make sure that every job that anybody leaves from, we really need to have it. You don't fill it, you split the especially at managers, you split the responsibility up. That gives 2 more people more responsibility. You can split the money up and pay the people. And that just comes, but we, knock on wood, we've been able to do this while the associate delight went up, the teammate delight went up, and importantly, I think it gave us permission to add a bunch of human practice around the best place to work. Our healthcare costs for our lower paid people are about basically family coverage for a person making $50,000, $60,000 a year in our company is $150, $170 a month. And we haven't increased that since 2010. So we dropped it from 250 to 175, or 500 to 250 if they get biometric screening, which is our wellness programs, they get to about 175. It's stayed that way since 2010. And that's against a trend increase. Peter and I are talking about 8-9% since that time frame. So effectively, by doing that, you've given that teammate, 7-8% a year value. And so working that hard on the people, doing it the right way, gives you the ability to have a minimum starting wage that passed $15 a long time ago, the healthcare costs, the amount of programs, and then all the standard benefits, 16 weeks for family leave. By the way, which is one of the morning statistics, 40% of people take family leave in our company are male. And so those of us the generation earlier, we would have lost our jobs if we had taken the time. So it really changes the dynamic of the when a family has a child, and it's been interesting. So doing it the right way, yes, associates light went up, but doing it the right way also gave us the money to spend for the teammates that are here to really add to the benefit structure, and we really gear that towards that lower half of the pay scale.
Thank you for that. Last question, and then we'll open it to the floor. I mentioned the Fortune magazine with your Change the World ranking as the #3 company worldwide. The corporate world has really sort of woken up and really recognized the importance of ESG, something the bank, and I know Ann played a great role in that, but has been focused on for years and years. And now that's coming out, and that's one of the reasons why you've moved to the top of the pile so quickly. Can you speak a bit about your approach and commitment to this and to the environment in general?
Well, the environment fits in the sharing success for your communities, which fits into what banks are here for, which is the oldest part of our company was founded someplace around here in 1784 when a bunch of people got together and said we need a bank to grow the capital to grow business. And by the way, repeat that story whether it's in Albany, New York, or Charlotte, or San Francisco, or Atlanta. You can go back and trace the lineage to all these places where they grew out of the community. So we've always believed, and it's not unique to our industry, to agree to feel that fourth estate, the fourth constituency, the community. The first strategic plan I prepared in 1994 for our company, had shareholders, customers, employees, and communities. So this is not a new concept. The reality, though, is ESG is moving that concept into a much more way you can scale it, for lack of a better term. So you're getting investors looking at everything. But the E part of ESG is environmental. We have a $125 billion environmental commitment. We're $70 billion the way through it. We'll probably end up getting through that, I'd say, over the next couple of years, and then we'll go out and double it up or do something again to increase it. It is everything under the sun. It is financing, wind power, solar power all across the world. It is investing in technology. It might be promising for things like sequestration and stuff, which people are still trying to figure out. It's green bonds, which are good because green bonds, it's the underwriter of green bonds, not issue. We issue them, but being an underwriter of them, what we're doing is providing a bridge for a company to say, I'm going to raise some money, I'm going to use it for these purposes, which the immensity, the demand to actually help keep the climate change and the environmental situation in control is a need of about $2.3 trillion a year. Right now, the world spends about $750 billion a year doing this. All the endowments and foundations and behind all our great universities and everything else and all our people have a total of $1.2 trillion in them. So the U.S. government federal budget, $3 trillion. You could spend it all in 1 year and then you wouldn't have anything for the next year type of thing. So the amount of money needed, it means you have to access more capital. Green bonds give you a way to do that. Basically, people raise money, then go spend the money to do types of things. So the commitment's there. We've done a great job. How we operate as a company, credits for hybrid cars, how we lowered our energy use, LEED Platinum certified skyscraper, the first one in history, how we, paper and everything else, but you keep just driving it down. And so it's innovation, it's capital, it's morphing more into how we bring more money to the task, and that's the thing we call blended finance. And I guess a couple weeks I'll be with the G20 with Joachim Levy, and we're trying to get people to understand how you can bring more money to the task by having development banks and others take more of the upfront and political risk and leaving the regular finance industry to finance the actual project without that risk. And it's kind of interesting, and layers of risk and things that you can do so you can bring energy to parts of the world that have to have energy to develop. It would be not good for the rest of the world to say, oh, yeah, we develop the coal and oil and things like that, but you can't have it. And that's just unfair. And so we have to figure out a way to get those places energy to develop also. And that's going to have to be done with a lot of different structure financing, because it's hard to say, go out and do a 30-year hydropower project in a country that's had 12 different leaders in 25 years. It's just impossible to take the risk. But if you get the World Bank to take the risk, so we're pushing them to be more aggressive. So the environmental thing not only goes to money, it goes to intelligence and the teammates we have working with us in a second to that.
We're going to open it up for anyone from the floor that might have a question. Everyone is shy today.
Just stare at each other. So.
Stare at each other.
Okay. Go ahead.
Okay. I think Zelle and Symphony are great examples of traditional banks partnering up to support a separate tech entity that can compete and actually win against the likes of, say, PayPal, for example. I think Zelle recently surpassed Venmo in volume recently. Is that something that you, Brian, are directly involved in? Is that something that you are a huge advocate for? It'd be great to learn more about your role in those models.
So, when you run a company our size, it's the greatest job in the world because you're not directly involved in anything. But you have to have processes and steer. But that particular Zelle is the peer-to-peer payment thing capability. We had a thing in the industry called Clear Exchange, which is one capability. We decided as the industry we had to move this thing up to be more competitive, and so we rebranded Zelle, we increased its capabilities, but more importantly, about 10 of us decided to push it, and then we opened up the whole industry. And we're growing at 100 and some % a year on it, and so yes, I was involved in it through the group that helped formed it and the team that did it, but they really did all the work and they did a great job. But the real question was, how do you get customers to use it? And that's what you're starting to see, the usage go up, and it's really a much better way to move money because you're moving within your bank account than other techniques out there, and it's very powerful. And we'll be bigger. We'll probably catch Venmo over the next year or so in terms of our volume only on that. We're about 20-odd% of the total volume of Zelle, and we're driving it 100% a year. So it does it. But it's still, when you add it all up, you got to have that. You got to have Visa Pay, you got to have Apple Pay, Samsung Pay. You got to have all these different techniques. So Tong Nguyen, who is one of our senior executives that is co-head of our consumer business, which makes $10-12 billion after tax a year. So he's got a big job, but he also runs payments for the whole company, and he's the one that actually drives that and does a great job. But I had to work with the industry more, with the other CEOs, to say we're going to do it. And that's something that it's been interesting over the last decade, the last 5-7 years, with a group of banks, some of the regional banks and some of the G-SIFI banks, the largest banks. So Jay Hooley, myself, and our colleagues, we basically sit there and say, we've got these big issues to solve. We'll put it together and solve it. Zelle was an application of that.
Any other questions?
There's somebody there. You got it, yeah? They're trying to get you on tape, so.
Uh-oh. We did a lot of business with you guys years ago, 10 years ago, when the market went bad, selling different properties that you guys had. And I was curious, it seems like the move from a lot of the large banks like yours has been to get away from servicing. Is that still happening? I haven't been following it at the level that I used to, sure, considering we don't do it now.
Yeah, so the mortgage business, one would say we had 20% share in 2006 and 7, but the reality is about 4 or 5% we did directly with the customers, and the other 15 we bought from correspondents and other people. That fed a servicing business, which we've wound down from 12 million units to 3. We only do mortgages for ourselves now, so we don't buy them from anybody else. We service them. That's part of our responsible growth. So every customer that has a mortgage with us for the last, 8 years or so, we have looked eye to eye with them and said, this is what you're getting, this is what we're getting, and this is how we're going to do it. And it was really an effort to get the business in a place you could actually grow from it. And now we have the digital mortgage, going to your other colleague's question, which is growing, and you can do a fully digital mortgage, and so it's pretty neat.
So your own portfolio loans are the ones that you guys are keeping? Yeah. You're not servicing for the others? Okay, thank you.
market share between the giants and the independent banks in Massachusetts? How do you see that? My dad's here. So
in the end of the day, I think our industry will be analogous to what's gone on in different types of industries that have had major national brands emerge and still have local brands. So whether it's the Home Depot, Lowe's to the Green's hardware store in Wellesley, whether it's CVS, Walgreens to local apothecary, there's going to be different types of business models for different types of things. And in the view, we're still a massively unconsolidated market and in our industry, in our country. And so, we will take market share from everybody because we're going to be good. But, but the reality is, I started in this business, 30 years ago in the consolidation phase. And, if I had $1 for every consultant that came in and said there'll be no branches in 30 years, guess what? There are. And we'll have 850,000 people walk into them by this time tomorrow. There'll be there'll be 4 banks by now. There's still 6,000 banks. There's customer preference here. There's real people that really do stuff, and so I think the market will be populated by all different types of business models. And then there'll be some business models which are purely digital, and there are some that are purely physical, and everything in between. And that's fine. That's what makes the customers get great reward out of it. But we will work our tail off to grow our market share, and so that's. And so from the third quarter of last year to the third quarter of this year, our consumer business grew checking accounts by $25 billion, which is a good-sized bank. And so, but that's all over the country. It's not here in Massachusetts, so tell your dad not to worry.
Any other last question? If not, maybe I'll ask. Good, okay, great.
Hi, Bob Morrow, Boston College. I have a quick question about Brexit. If you could talk a little bit more about that. Massachusetts' economy is particularly exposed. I think UK is our 4th largest trading partner. Ireland's up there as well. How do you plan for this, or is it possible to plan?
Well, the problem. So I happened to be in England after the Chequers weekend thing, and I met with the various officials there, and they were very assured that thing was the roadmap to get it done. And guess what? All of 3 months later, 4 months later, it isn't done. And so this is very difficult. And so I think you hear the outlines of an agreement. Goods and services. The idea is they'll have a deal. They think they've got it figured out for the Irish border to have an open but regulated border for goods and services, so it can't be a back door, or people can't be a back door. They've grandfathered the people who are in the country in the UK to stay. They have done a lot of things, but it's still not an agreement. And so we are now in November 2018, in March 2019, it happens. And so the assumption has to be that you're in a hard Brexit format for financial services, i.e. we're going to open up that day with no rules, regulations, structure about what you have. So what do? We're prepared to operate. So we have a Dublin bank, we have a Paris broker-dealer, that we're doing, and then we have the UK to serve the UK clients, and we moved a fellow over named Bruce Thompson. He's the chair of the Irish bank. It's getting stood up, so as they say, and then we'll merge some things together to make that the EU bank, Bank of America Europe, and then on the security side we'll run out of a Paris broker-dealer. All that being said, it is disruptive. You just hope that cooler heads prevail and say we shouldn't have the citizens have to pay a price. We shouldn't have the economy have to pay a price. Let's mitigate it. And you hear that, but that's a tough political stance to take, a situation to get rectified. And so I think just watch it play out. But there's no one has any, other than maybe a very narrow group of people in the EU and Britain that are actually talking to each other. Everybody else is speculating about what's going on because every day the idea of the moment changes, and this is a very difficult thing. I think the longer term ramifications for it are serious because it was good to have a collective group of countries of that size, an economy about equivalent to the United States, that we could have one trade agreement with, have one understanding how you operate, and I think that you now have two, and it takes years to do a trade agreement. you know, and so Britain's got a lot of work to do to get trade agreements with all these countries, and so everybody will deal with them on some manner, but over time they're going to have to codify that. And think about, you know, think about what it'd be like to say, let's go back before the federal Constitution and reestablish all those independent groups that have to negotiate, you know, that they haven't had for a long time. They haven't had the trade negotiators, the military type of stuff. It was all done at the EU level, and now it's all gone. So it's going to be very disruptive, and but it's done. The will of the people. There's a lot of people who hope they'd have another vote. Tony Blair, I think, wrote an editorial last week and said we should have another vote. Let's put ourselves, you know, sort of out of our misery, and let's call this over. I don't know. I don't think it'll. I don't know. I don't have any special insight. But you sort of say, so what's the premise by which you take another vote? And then you asked once, you got an answer, and so there's going to have to be some sort of log jam break to get that done. So I think it just proceeds the way we are, and we kind of bang around, and we get there, and then people will say, oh my God, it's done now. Let's now write a set of rules, and they'll move pretty quickly after the March.
Hi, Brian. Linda Henry from the Boston Globe. Bank of America has taken a really interesting and exciting leadership position on climate change. Can you talk to us a little bit about what you're doing and why this makes so much sense for your bank to be doing it?
Well, in the end of the day, you know, we believe we have to make the transformation from the current fossil fuel environment to a new energy environment which does include fossil fuels. It takes a lot of money, a lot of time, a lot of science, a lot of people's work, a lot of policy. And so what we add to the equation is, you know, financial knowledge and understanding how to bring more money to the task. And then we add a bit how we behave as a company. And so, you know, why it's important to us is we think it's a major issue, you know, for society. And you know, I had an interesting dialogue with somebody staying in my office, and we were talking about the pipeline to fuel the power plants that Tom has educated me over the years that we need that to avoid burning coal, and the grid's unstable and all this stuff, and without going into all that. And this was somebody from Rhode Island. I was talking to the person. I said, you know, we need to figure out how we get some of this, you know, New England energy stability. And the person said, well, the environmentalists think, you know, looked down at Boston Harbor and said all the water's coming over. And I looked out, and one of the big tankers was coming up the harbor. I said, you think we're going to power ourselves using those things? We got to get this. So there's steps that you have to take here. And so, you know, we believe that you can't switch it on and off overnight. Our job is to help people understand the duration. So we wrote in a letter that they should have stayed in Paris because the world agreed to try to do something. It wasn't enough, but they agreed to try to do something. We were of record of that. What will happen, we'll see play out over the next 4 or 5 years. But the good news behind that, the countries of the world have all agreed this is a problem. And so they're acting more in unison to try to bring the task. So we go to the G20 in a couple weeks. It'll be a lot about bringing money to task and new financing structures and blended finance and all these wonderful words. But the reality is this corporate world knows that they have to help drive this, how they behave, how they use energy. And it's also in their best interest, and it's also their teammates are driving. So if we were, you know, if you have a bunch of teammates working for you and you don't understand how absolutely committed they are to change this, we're 50 years past Earth Day. You know, this is not a new concept. So we do it because our teammates want it. We do it because society needs it. And we do it because we have a special need. We have money. As we said, lawyers, guns, and money, as Warren Zevon said. We have money, and other people have other stuff to bring to the table. And our job is to bring the money and a financial thinking, which is really the guns analogy, to help figure out how to structure a lot more finance into it. But this goes back to that idea that, you know, we have to share our success with communities, and one way you do is share that financial acumen and that money to help drive it forward.
Thanks, Brian, and thank you all for coming. And Warren, take it over.